So, Brooks, many investors and some clients that I've worked with personally, I've noticed a trend as they come within a few years of retirement, they begin to um, fall under the perception that they need to start pulling risk off the table in a pretty dramatic fashion. And when I question them on that, generally the response is, "Well, I don't have a long time horizon. I'm not 30 years old anymore. I'm 2 or 3 years away from retiring." So, they have this standard idea in their head that, risk needs to be almost completely taken off the table, as that is their entire nest egg that's going to dictate the viability of their retirement moving forward. So, can you talk a little bit about risk management as you approach retirement?
Oh yeah. No, I mean it's a very, very common thing that we deal with in trust, especially making that bridge from, constantly working, always having an income, putting away savings, building this nest egg. And this nest egg has grown and it's been allocated probably a little bit more aggressive than what they would want going into retirement. But when they hit the retirement phase, it's not the time to take the foot completely off the pedal, right? I mean, we need to slow down a little bit, but that doesn't necessarily mean we need to completely come to a stop on the way we're doing our investments. One thing that we have to work with is their liquidity needs, making sure that they have ample enough liquidity in their portfolio, but still have enough exposure to the equity markets to, last for the rest of their lifetime because that income that they were generating is no longer there. This nest egg is their income for the next 20 to 30 years. And with the cost of inflation and healthcare and travel, long term care, nursing homes, gifting to kids, all of that stuff, as we've seen especially over the last few years, has gone up exponentially. And the only really way to combat that is to keep that necessary evil that some people would regard it to of the equities and the volatility in the portfolio for those funds to last for that lifetime. Because while they might not be 30 years old anymore and they might not have as long a runway till they are to part, it's still a long time.
Right.
What thoughts do you have?
Yeah, yeah, I think we're on the same page there. I think there are things you can do. One thing that I do advise clients to try to mitigate the risk of is a significant market event within a few years, either before or after retirement. So I think, there's literature out there that talks about bond strategies or implementing some fixed income to cover any distribution needs within those first few years, leading up to or immediately following your retirement, to prevent against any significant market downturn at the same time in which you would need to start drawing on that portfolio. But ultimately, I agree with you. A lot of these rules of thumb that a lot of people are aware of, such as the 4% safe withdrawal rate, those were based on the fundamental tenet that you have enough equity exposure in the
Mm-hmm.
portfolio to fund 25 or 30 years of those distributions. So I know I think maintaining adequate equity exposure, strategic equity exposure,
Mm-hmm.
is very important, and I would even advocate that the most important time to ensure that your portfolio is structured the right way are those first few years before and immediately
Yeah.
after retirement.
Yeah, and I would agree with that because I mean, I've again referencing kind of the last couple years. I feel like there's been a lot of draw to taking our foot off the pedal completely, putting it in a fixed income money market kind of environment. And while that's been great since all these interest rate increases and it's been providing a very risk free return for these clients, it's not a long term investment strategy. It's not something that's going to be sustainable for that portfolio. Now is the time to specifically say, hey, if I've got all of this sitting over here in cash, or if I need to readjust my strategies, now is the time to do it. Going back to your point about the safe withdrawal rate, 4.5%. You can Google that, and everybody goes by that. But if my portfolio is only generating 3 to 4% because of how safeguarded it is, but I'm withdrawing 4, I'm right out the door from day one. I'm eating into my principal and not letting my assets be able to grow for as long for my lifetime and maybe even some generational planning that you're wanting to do for your kids.
Yeah, that's a great point too. I think, we can look back, through history and see how these various asset classes have performed over time. And, over long periods of time, equities generally outperform. bonds come in next, and then you have money market, following up on the tail end. So to me, it's more a matter of, maximizing your returns if you have a long enough time horizon. And when I say long enough time horizon, we're talking 20 to 25 years, of a retirement time horizon. So I think that, this kind of leads into some of those strategies where we talk about, bucketing your money into various apportionments, such that, the equity portion, you can look back through history and say that growth on equities has historically outperformed fixed income. So for the money that you don't intend to spend in the first 5 years of retirement, first 5 to 7 years, allocate that to equities, and then pair your strategy down from that starting point.
Yeah, and I think that leads us into a great next question, Grant, and talking about that localization of what is the bucketing strategy that you would recommend. I mean, obviously there's not a one size fits all, but kind of go through the different concepts of those different buckets.
Sure. Yeah. Yeah. The bucketing strategy is a very simplistic approach to retirement planning. It's a good place to start, and it's easily understandable. The basic premise is, day one when you retire, to have enough set aside in a money market or other cash equivalent asset to fund the next 12 to 24 months of your spending need. So the difference between, your total expenses and then your income, generally Social Security, that's your portfolio spend. So have that in money market. Anything that you intend to draw from the portfolio in the next, generally it's, 5 to 7 years, have that invested in a less volatile asset class like fixed income or the bond market that will generate returns in excess of money market, but doesn't necessarily entail the same risk that we've seen historically in equities. Therefore, allowing your equities to be, 7 years plus, and that way you're not forced into a situation where you're having to liquidate equities when they're down 20 or 30% to live on. And it gives you peace of mind when you do see those big market events that that your equities won't have to be touched for your living expenses for the next 5 to 7 years.
Yeah, you pretty much took the words right out of my mouth, because I mean, the one thing that I help clients with the most in making sure that they're comfortable with their overall asset allocation is backing into that factor, right? If we're going to say that I need $100,000 a year to live off of, and I'm going to make Social Security of 50, that means $50,000 of my portfolio is needing to be sent out to me every single year. Okay, so that needs to be readily accessible to me. If I go and put you in a 60-40 allocation, 60% to equities and stocks, 40% to fixed income and bonds, that 40% needs to represent 5 to 7 years of that $50,000 that I'm needing to send to you. Anything less than 5 years, we know that we've over allocated you to equities. Anything excessively more means that we might not be aggressive enough, but there's always that emotional side of things, right? Because if you have that education to say, if I turn on the news and the market has gone down 20 to 30%, in reality, I shouldn't care. Is it going to hurt to open my accounts and see how much my money's gone down? Of course, but we know that's temporary. But if I know that in the knowledge that I have enough set aside in my fixed income outside of the equity market to live off of comfortably for 5 to 7 years without having to sell any of the equities at a downturn, and allowing those equities to make a rebound, and then when they do, which it always does, at least up to this point in the time of the history of the stock market, now I can take those market equities that were at a loss, they've now rebounded, and now I can go replenish the fixed income that I've been living out of for 5 to 7 years to basically put myself back to where my overall balance needs to be.
Yeah, very well summarized. I think this strategy is not the strategy that maximizes returns at all costs, but it's the strategy that ensures you're not financially destroyed in the event of something unexpected happening.
Again, another place for a financial advisor to step in and really balance that out between the emotions and what you're actually needing.
Absolutely.